Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how much you should be spending on property maintenance and improvements. It's one of the advantages, I guess, of investing in property is that we can look for ways to enhance its value, make improvements, and that consequently builds our personal wealth. But I guess arguably one of the things you could think is a disadvantage is that dwellings typically require, or almost always require, ongoing maintenance, and that maintenance cost obviously eats into the property's income that it generates and therefore the investment return. However, minimising or avoiding maintenance is a false economy. Maintenance cannot be avoided, it's only deferred because problems don't just magically resolve themselves, of course. And typically with a lot of issues, they tend to get worse if left unattended. And so the rectification cost can increase. So either way, you're going to have to do the maintenance at some point. Or if you eventually sell the property, most potential purchasers are going to factor in those costs into the price. So you're either going to take a lower price or you're just going to have to do that maintenance one day. And if you don't fix the problems, as I said, they could end up costing you more. As a general rule of thumb, it's reasonable to expect to spend somewhere between 0.4 and 0.75, 0.75% of a property's value on ongoing maintenance. Now, you might not need to spend that every year. In fact, there might be periods of time, 5, 6, 7 years, where you don't spend hardly anything at all. But let's say over a 10-year period, spending an amount of somewhere between sort of 0.5 and 0.75% of a property's value is not an unrealistic expectation. And really, it depends on the type of property, its finishes, its amenities. And of course, houses tend to cost more to maintain and improve than apartments do. There's some items that you can spend money on that are going to have a positive impact on rental income. And they're often good to spot and identify because quite often for a relatively small investment, you can get a pretty good return. In fact, I would say a very good return for some of these items. And so to give you sort of 4 examples of what these items are, typically air conditioning, particularly in apartments, is highly desirable. And a split system that acts as a heater and an air conditioner is a pretty good solution. And that can increase a property's rental income by $10 to $20 a week, sometimes even slightly more. And the total cost to install a split system these days is substantially lower than it was 20 years ago when I installed my first split system in a property. So the cost is around about $3,000 or $4,000 all up today to put a split system in a property. So pretty good outcome. Secondly, new carpets tend to really change the amenity within and livability within a property. Regrouting tiles in kitchen and bathroom not only is it good preventative maintenance, but it can have a really positive impact on a property's appeal, and I've done that in a property that I have. We regrouted, and it made it look like it'd been completely retiled. And sprucing up kitchens and bathrooms. Now, it's advisable to make sure that the kitchen and bathroom are in the relatively same standard. Otherwise, it kind of looks a bit odd if you sort of renovate the kitchen and the bathroom's still in original condition. But you can do it quite cost effectively. In fact, you should be doing it cost effectively. For example, replacing flooring with, say, new vinyl, painting cupboards, replacing the door handles, replacing bench tops and tapware. So keeping the sort of structural stuff in there. If there's an old oven in there, put a new oven in from appliances online or one of those online retailers. You can pick something up for relatively cheap or cost effective, and just avoid doing a kind of full kitchen refit or bathroom refit. Sometimes it's like peeling an onion. As soon as you start pulling things off the wall, you start to find more and more problems. The key thing is you need to make sure the standard of your maintenance and improvements is in keeping with the area and tenant and expectations. if you're renting a property for $1,000 a week, your tenant's going to probably expect more than if you're renting the property for $200 a week. Of course, common sense, right? There's also some items that you can spend on that improve the value of a property, and they're also good to consider in order to create some equity. Of course, typically maintaining a property or spending money on maintenance preserves the relative value of a property, whereas the things that I'm talking about that are regarded as improvements tend to enhance or increase the value of a property. So, for example, some properties don't really lend themselves to a cosmetic kitchen and bathroom renovation. So a substantial kitchen and bathroom renovation tends to add more value than it costs. Improving natural light in properties is also very good. That might just be through painting, painting all white inside, for example, installing skylights. These sorts of things can add a lot of value. For a house, adding a bedroom, of course, enhances its value. So they're the examples of some things that add a lot more value than what they tend to cost. There's non-cosmetic items that you can spend money on, like rewiring, re-roofing, plumbing. These sorts of things tend to have very little impact on value. So they're sort of sunk costs. Sometimes they're unavoidable. But they're not the sort of things that are going to really move you forward from an overall wealth perspective. Of course, it's important not to go overboard. I always think if you can't really expect your tenant to look after your property if you don't look after it yourself. So therefore, it's important to be, I think in my mind, respectful to the tenant, making sure that they've got a nice home to live in, that you're looking after the property and so forth. And as a result of doing that, I think it's then a reasonable expectation for you to ensure that they look after the property as well. But you don't need to put in stone bench tops and European appliances. For the most part, for most investment grade properties, that's just not necessary. So it's not about doing a renovation to your standard or what you'd like to see. It's very much a financial decision, not an emotional one. You've really got to weigh up the dollars and cents and make sure it's sound. If you have an apartment, you would know that an owner's corporation is responsible for maintaining common areas. So that's important to ensure that they do that. They should be looking for opportunities to improve the property's street appeal, security, and obviously structural integrity. And where possible, owners' corporations should be looking for ways to improve the amenities of a property to ensure they are as comparable as property to more contemporary developments or apartments. So installing video intercom for additional security, for example, renovating stairwells to make them more inviting, resurfacing driveways. These are the sort of cosmetic things that an owner's corp can do to really improve the appeal of a particular block. From a taxation perspective, you should be able to claim a tax deduction for repairs and improvements. And typically the cost of any repairs and maintenance is generally deductible in the year that you incurred the cost, except there's three exceptions to that rule. So if there's a replacement of entire structure or unit of property, such as rebuilding a fence or replacing a stove, that needs to be depreciated. Number two, if you're improving the item beyond its original condition, so that's, really renovations, extensions, alterations, these sorts of things. So if you're making it better than what it was when you first purchased the property, that is an improvement and needs to be depreciated. And lastly, initial repairs after acquiring the property. So that's if you buy a property, but before you put a tenant in it, you spend some money, that's going to be regarded as a improvement because you're improving the property beyond the point that you or condition that you purchased it in. An improvement or maintenance is more of a investment than it is an expense. Quite often, particularly if we fund a improvement from additional borrowings, which I'm going to talk about how to fund maintenance in a second. But quite often it can be cash flow positive. Okay, it's not going to change your life, but it's really a case of enhancing an investment's income stream rather than reducing it. So let's take the example of putting in a $4,000 split system air conditioner, and let's assume it increases your rental income by $10 a week. So really the after-tax increase in income as a result from doing that, after tax deductions, interest costs and so forth, and I've got the calcs in the show notes and on the blog, of course, the improvement is about $324 per annum. So just over $300 a year improvement after tax income. And that's not going to change your life, right? So, looking for all those opportunities and all the properties that you might own is going to do very little from a cash flow perspective. But I guess the point is that it's not going to impair your cash flow. It only improves it. And it's going to improve the value of the property. And it's going to reduce your risk. And it reduces your risk because it makes your property more marketable. And there's less likely that there's going to be any vacancy rates or vacancy times, or at least they're minimised to some degree anyway. So quite often we look at maintenance and we think, how can we get out of spending the money? But it really is a good return on investment. In terms of funding, where possible, and particularly if we're funding major maintenance and renovations, I like to advise clients to use borrowed funds to do that. And that would be true even if you had the cash savings readily accessible to fund the expense. You're actually better off to increase your loan and leave those cash savings in a linked offset account than pay for the renovations with cash. The reason is that you preserve or maximise the future tax deductible loan, which might be important to you. Might not be important to you today, but it might be important to you in the future. The simplest way to do that is to always ensure you build buffers into your loans. So, for example, if we help a client go and buy an investment property, we always try and borrow, $20,000 to $50,000 more than what they'll really need, so that they've got access to those monies via redraw, should they need to use it for those sorts of things like improvements and maintenance. In terms of arranging these things, if it's just minor repairs or minor improvements such as installing a split system, typically you can ask your property manager to arrange that, get a few comparable quotes and then choose the right provider. However, if it's a larger project like a kitchen and bathroom renovation, it's best to get sort of an outsourced business that specialises in completing those sorts of assignments. They'll have relationships with tradies and these sorts of things. They'll be able to project manage it for you. The last thing you need is a headache of running a renovation to a property, and there's businesses out there that will look after that for you. The only time that I would say it's wise to really minimise the amount you spend on maintenance is if you had an asset where it's predominantly land value. So if you've got a very old rundown house and the potential purchaser is likely to come along and bulldoze that house should you ever go and sell it, and the building value is very minimal, then really all you want to do is spend the minimum to be able to put a tenant in it. You don't necessarily want to end up spending a lot of money on a property like that, as you might not get a good return on investment. Looking after your property, looking for ways to enhance its value, its appeal, its income will serve you well in the long run. It'll help minimise vacancies, maximise rental income, and enhance its capital growth prospects, make sure it's comparable and so forth. Property maintenance is an important ingredient to successfully building wealth with property. It's not an expense that should be avoided at all costs. It's more of an investment. Okay, so that's it for this week. Bit of a shorter episode this week. As always, if you enjoy listening to the podcast, please do rate it on Apple or wherever you listen to your podcasts. Leave a rating, leave a recommendation. And most importantly, please share. So if you know any friends, family or colleagues that would enjoy listening to the podcast, all podcasts, certain podcasts, please do share. The more the merrier, of course. And until next week, bye for now.